Our stocks that we try to look at is longer term in nature, and we're looking at stocks that have the potential to grow substantially from here. Now, some of them are already growing, some of them have triggers that will enable growth in the future. Many of them, by definition, will be smaller in nature because many of the large caps don't have that much room to grow. However, we are including a significant number of larger caps as well, which are poised or have enough of a room to grow in the future. More important to us is also the fact that we diversify. We don't keep only 10 or 12 investments. We diversify to above 30 different stocks in different industries and different sectors in order to be able to participate in a broader economy. We don't want to at the same time be too selective in terms of having so many stocks that it won't make any single stock won't make a difference. But our past checks have told us that having a 30 stock portfolio versus having an 80 stock portfolio is not substantially different, especially if you are betting on certain triggers that need to work in the long term, and single stocks deep fall should not affect you or your sentiment in the longer term. The debt portfolio is primarily focused on a relative amount of safety. We have used ultra short term and liquid funds, and more recently more into liquid funds through the investing process, and will look at interest rates and the market credit risk as a prime criteria for focusing on debt. But we don't buy directly any company's debt right now. We use mutual funds because they're a more tax efficient route and also a more liquid route for our debt allocations. Important to our system is the allocation between equity and debt, and this is determined by an algorithm that determines how far away you are from your goal, how much you need to be, and whether we should be increasing equity positions or decreasing them. So we will increase equity positions in times when the equity market is low, as has been in most of 2018, later half of 2018, perhaps early 2019, and we will reduce equity allocations when the markets are high. So the algorithm balances itself out over time. We use goals and equity exposure as a primary tool for mapping how customers need to be exposed to equity. However, if a person does not have goals, we actually use a simpler framework that allows us to determine exactly how much goes into equity, and therefore use the equity allocations to just add more and more money into the same stocks that we have over a period of time. So we don't invest all in one day, we invest it over a period of 6 months. Any new customer gets a 6-month runway to actually be into the portfolio, because we're thinking longer term and we're not looking at pouncing on all of the stocks at one time.